Hey, and welcome to the Deep Dive. Got a fantastic stack of material in front of us today, all thanks to you, our listener, for sharing these sources.
That's right. And anchoring this particular deep dive is, it's a real gem, a letter from Warren Buffett to his partners dated December 31st, 1957.
Wow, 1957. That really feels like stepping into a time machine, doesn't it?
Yeah.
He'd only just started his first partnership, Buffett Associates, Ltd., like the year before.
Yeah, really early days.
So, our mission is clear. We're going to open up this letter, unpack this incredibly early snapshot of Buffett's thinking, his view of the market, how he approached strategy back then, and the initial results for those first partnerships. We want to really pull out the valuable insights from that era and see what they mean for you right now.
It's like getting a look at the blueprint, isn't it? Before the skyscraper was built, seeing the principles that would later define his success already taking shape. It's pretty remarkable, especially in the context of the late 50s.
Okay, let's dive in then. First up, what was his perspective on the overall stock market scene in 1957, based on this letter?
Well, he was pretty direct about it right from the start. He believed the general market, particularly what he called blue chip securities, were priced above intrinsic value.
So the big, well-known companies were looking expensive through his value lens, even back then. Is that the idea?
Exactly. Spot on. And based on that assessment, he made a pretty cautious forecast. He wrote that the probability was very slight that current market levels will be thought of as cheap 5 years from now.
That's not exactly a ringing endorsement of where the market was valued, is it?
Not at all. Very cautious.
Okay, so he saw an expensive market, especially in the blue chips. How did that shape his strategy? What was the plan depending on, what the market did next?
He laid out a contingent strategy, but, and this is key, it was firmly rooted in his core approach. If the market kept climbing significantly, his plan was to reduce general issues where they could maybe realize profits and lean more heavily into what he called workouts.
Okay, and the flip side?
Conversely, if the market fell enough to become significantly undervalued, he said he might even consider using borrowed money in general issues. Leverage, essentially.
But the really interesting part, I think, comes next, where he kind of pivots and says, despite all this talk about market levels, analyzing the market isn't really his main gig.
Yes, that's such a crucial point, and it comes through so clearly even in this early letter. He writes, primary attention is given at all times to the detection of substantially undervalued securities. Full stop.
Right.
The market level is context, sure. It might influence where the opportunities pop up or maybe the mix of the portfolio. But that hunt for undervaluation, that's constant, nonstop.
That focus makes total sense for a value investor. So given his view, what did the market actually do in 1957, according to his letter?
He described the market action as a moderate decline in stock prices. And I think he used the word moderate quite deliberately. Well, maybe suggesting the narrative out there might have been gloomier than the actual price movement warranted, especially when you compared it to the fundamentals.
And he noted something specific about that decline, that it was considerably less than the decline in corporate owning power under present business conditions.
Yeah.
What did he take away from that disconnect?
That observation led him to believe the public was still very bullish on blue chip stocks and the general economic picture. The fact that stock prices hadn't dropped as much as earnings suggested this sort of persistent optimism, which, from his value perspective, meant things were likely still priced, optimistically, or just plain high.
Which circles right back to his conclusion about the market level at the end of 1957.
Precisely.
Yeah.
He reiterated that the general market was still priced on the high side based on long-term investment value, still too expensive for his liking overall.
All right, so the market was down a bit in 57, but still felt rich to him overall. How did that environment then influence the portfolio itself and the execution of his strategy? You mentioned to shift towards workouts if the market went up. What happened in a moderately down year?
Well, that moderate decline actually created, in his words, greater opportunity among undervalued situations. So it allowed him to deploy capital more effectively in his primary area of focus.
Makes sense.
And as a result, the portfolio shifted. At the end of 1956, he said about 70% was in general undervalued issues and 30% in workouts. By the end of 1957, that ratio had flipped quite a bit. roughly 85% undervalued situations and only 15% workouts.
Okay, let's pause on that term workout because it seems pretty fundamental to his strategy and different from just, buying a cheap stock. How did he define it in the letter?
Yeah, it's important. He gives a very clear definition. A workout is an investment which is dependent on a specific corporate action for its profit rather than a general advance in the price of the stock.
So while most investors are kind of betting on the mood of the market lifting their stocks, a workout investor is betting on a specific, often kind of predictable event happening within the company itself.
Exactly. That's a great way to put it. He listed examples of these corporate actions, things like sales, mergers, liquidations, tenders, etc.
Which means the primary risk isn't the whole market crashing.
Not for that specific investment, no. The risk in a workout, he says explicitly, is that something will upset the apple cart and cause the abandonment of the planned action. Not that the economy tanks or the general market falls. It's a totally different risk profile.
He also talks about taking some pretty significant positions in 1957 where they plan to take some part in corporate decisions. That sounds even more active than a typical investment, right?
It is, yeah. Definitely more active. He describes two such large positions initiated that year. One he planned to build to between 10% and 20% of the partnership portfolios, and the other was targeted at about 5%. So these weren't just casual shareholdings, these were strategic stakes, serious positions.
And these weren't quick flips, obviously. He expected these situations would take. What was the time frame?
He estimated in the neighborhood of 3 to 5 years of work, so patience required. The goal was a potential for a high average annual rate of return with a minimum of risk and, crucially, with very little dependence on the general action of the stock market.
Right. So insulated somewhat.
Exactly. He even notes they would likely lag behind the action of the market if it rose substantially, which, again, required a specific kind of patience from his partners.
That patience, especially when you're building these really large positions, leads to what might be the most counterintuitive idea in the whole letter, the sterile stage.
Ah, yes, the sterile stage. This is one of those pure Buffett insights, I think. When they are in the process of accumulating a large position like that 10-20% one, he says their primary interest is to have the stock do nothing or decline rather than advance.
Wait, hang on. You want the stock price to stay flat or even go down while you're buying it? That seems to go against everything conventional wisdom tells you.
It absolutely does, but the logic from an acquisition standpoint is actually pretty simple. They're trying to buy a significant chunk, potentially 10% or 20% of the entire company.
Right.
So if the stock price jumps dramatically while they're still out there buying shares, it makes their buying much more expensive, much more difficult, and it could potentially prevent them from building the full position they want at an attractive average cost.
So that period while they are quietly buying up shares, that's the sterile stage.
Yeah.
Where price movement upwards is actually a bad thing for them.
Exactly. That's it. He explicitly states this policy, while it requires patience, is intended to maximize long-term profits. It's a strategy focused entirely on the successful acquisition of value, not on getting some quick market pop.
Okay, let's see how this strategy, this whole approach, played out in the real world in 1957. He compares the partnership results to the Dow Jones Industrials. What did the DJI do that year?
Well, the DJI didn't have a great year, as we mentioned. It started at 499, ended at 435. That's a loss of 64 points.
Right.
After adding back about 22 points in dividends, the total loss for the index was 42 points, or 8.47% for the year. Pretty significant drop. And he notes that most investment funds at the time also showed a loss.
Okay, down 8.5%.
Uh-huh.
And his three partnerships that had started back in 1956, what were their results?
They were positive, which is the first key difference. The returns were about 6.2%, 7.8%, and 25% based on their net worth at the start of the year.
Wow, 25%.
Yeah.
That one really stands out dramatically compared to the others, and especially the market being down 8.5%. How did he explain that vastly superior performance from one particular partnership?
Yeah, it's a big difference. He used it as a prime example, actually, to emphasize the importance of luck in the short run.
Luck, really.
Specifically, he tied it to the timing of when funds were received by that particular partnership. Apparently, that partnership started a bit later than the others, meaning its funds became available at lower market levels in late 1956 when, as he puts it, several securities were particularly attractive.
Ah, so they had cash when things got cheaper.
Exactly. The other partnerships had already deployed most of their capital earlier at higher prices and just couldn't take as large positions in those specific bargains when they appeared.
So even though the portfolios were, as he said, basically invested in the same securities and approximately the same percentages eventually. That initial timing of when the money came in caused that big variation in the short-term results for 57.
Precisely, yeah. He fully expected their performance to become much more comparable in the future as those initial timing differences ironed out and the portfolios fully converged.
What was his long-term target performance he mentioned? Like, what was he shooting for?
He stated he would be quite satisfied with a performance that is 10% per year better than the averages, which is, a pretty ambitious goal over the long term.
Definitely. And how did he view 1957 relative to that long-term goal, given the results?
He considered 1957 a successful and probably better than average year in relation to that 10% bogey. Beating a down market by that much was clearly a good start.
He also mentions 2 partnerships that started midway through 1957. How did they fare just for the rest of that year?
Right. For the balance of the year, from when they started, they performed roughly in line with the averages, which were down about 12% over that specific period. Again, he notes their portfolios were quickly aligning with the others, buying the same things.
Let's dig just a little deeper into why their performance was relatively strong in 1957, which was, a down year for the market overall. He credits it partly to the market environment itself, doesn't he?
That's right. He explains that their performance relatively is likely to be better in a bear market than in a bull market, which makes sense, right? The strategy isn't really optimized for riding some speculative wave upwards. It's designed to find value and manage risk, which tends to shine more, relatively speaking, when the overall market is struggling or going down.
And he clarifies that in a year with a big bull market run, he'd be well satisfied to match the advance of the averages. It's about consistent relative outperformance over time, not necessarily leading the pack every single year, especially in roaring bull markets.
Exactly. It's a marathon, not a sprint mindset. And despite the varying returns among the partnerships in 1957, he makes this really fundamental statement about the underlying value of the holdings at year-end.
Yes, this is key to that whole value mindset, isn't it? He says the portfolio represented better value at the end of 1957 than it did at the end of 1956.
And that's the core insight right there. Even if the market price of the holdings didn't fully reflect it equally across all partnerships in the short term, the underlying quality and discount of the assets themselves had actually improved.
Why? What were the reasons?
2 main reasons he gives. 1, due to generally lower prices during the year, which let them buy more attractive assets cheaper. And 2, having more time to acquire the more substantially undervalued securities, which can only be acquired with patience.
That brings us full circle, back to the patience thing and that sterile stage concept we talked about. The goal isn't just finding undervalued things, it's successfully acquiring them, accumulating the position, which takes time and a willingness to see prices stay flat or even dip while you're buying.
Right. He notes that largest position, the one planned to reach 20%, simply couldn't be rushed. And during that lengthy acquisition phase, the ideal scenario for the buyers, counterintuitively perhaps, the stock doing nothing or even declining a bit. It just underscores that the focus is entirely on building this collection of solid, undervalued assets over the long term, regardless of the immediate market reaction or noise.
So looking back at this 1957 letter, this early snapshot, what are the enduring core principles that just jump out and are still incredibly relevant for investors today?
Well, you absolutely see that unwavering focus on intrinsic value, on identifying undervaluation, and it's completely detached from trying to predict market movements. That's crystal clear. You see the strategic deployment of workouts as a way to generate profits that are hopefully independent of general market sentiment.
Right. Diversifying the sources of return.
Exactly. And maybe most critically, you see this deep understanding of the patience required to acquire meaningful stakes in undervalued assets. Along with the recognition that short-term performance can be noisy, it can be influenced by factors like timing and luck. But long-term value creation, that's the true objective. That's the end game.
They're really the bedrock principles that defined his entire career, aren't they? Laid out right here, clear as day, in 1957.
Absolutely. It's all there in nascent form.
Okay, so here's where it gets really interesting for you listening. Think about that concept of the sterile stage, where Buffett is comfortable, maybe even prefers, an investment doing nothing or decline for a period while he patiently acquires it. Now contrast that with today. In a modern world where we're just constantly bombarded with real-time price feeds, endless news, quarterly earnings pressure, this urge for instant gratification, What does that 1957 preference for quiet accumulation and even temporary price weakness tell you about the true nature of building wealth over the long haul? Something to chew on, maybe, as you navigate your own path.
Indeed. It suggests the focus wasn't on the scoreboard's immediate ticker tape, was it? It was on the quiet, deliberate work of building value, position by position over time.